According to the American Association of Individual Investors, 42% of investors feel bearish about the outlook for stocks over the next 6 months. So, when you're trying to evaluate the investment risk, when everything feels uncertain, it's important for us first to start with some facts and take a look out here over really kind of the past 2 decades. What we'll see is that there's been a multitude of reasons for us to sell. We all know of COVID. We also know that there was bird flu, swine flu, all different types of flu, the avian flu. We've also had some debt crises and oil prices. We've had inflation. Let me extend even further. Prior to 2009, you'll see a multitude of recessions, even depressions, world wars, regional wars. But historically speaking, over that time, U.S. stocks, as measured by the S&P 500, yes, they've fallen, but they traditionally always rebounded. So your concern in the stock market and the valuation and investment risk, your concerns around that, they're not unfounded. They're actually very common. And it's actually one of the reasons why, as a firm, we no longer take risk tolerance questionnaires, because what they've actually been shown to do is when the stock market's doing well, people are willing to be more risky. And when the stock market's not doing as well, they want to be less risky. Makes sense. When we're making money, let's make more money. When we're losing money, let's lose less money. So your reason to sell is very well founded and it's very common. But if we extend out even further and we take a look here and we say, okay, investing at all-time highs, right? About 40% of people are concerned about the outlook for stocks here. In large part is because people are saying they're too expensive. If we do buy at all-time highs, if you take a look here over the 1, 3, and 5 years, what you'll see is the longer the period that we invest, the less of our likelihood of ending down more than 10%. Really, in holding that 3-year basis, 98% of the time, we're not down more than 10%, and 100% of the time on a 5 years basis. And look, it can be different over a period of time, absolutely. But it's important for us to get some context into not just what it is that we're feeling, but also what it is that we're seeing on a perspective basis. And that perspective basis extends as well to future returns. So looking here over kind of the past 4 decades or so, since 1988, what you'll see is that the gray bar on the left-hand side and the green on the right-hand side, what it shows us is that, historically speaking, investing at all-time highs, we have even better returns than any other given day on a 1, 3, and a 5-year basis. The reason why that is historically good news pretends additional great news. And really, people are buying into, right now, if you look at it, we have very strong earnings. And we're also seeing a major expansion, not just in AI, but we're also seeing as well in kind of our energy sector. And that extends as well into oil and gas. So feeling the way that we do about the riskiness of stocks and forward basis, okay, that's fine. But what does it mean for you specifically? We must start with the financial plan. On a basic level, when we're looking at wealth architecture within a financial plan, we're looking at the left-hand side, all of our assets, whether they're the value of the business, your future earnings, your 401k, IRA, real estate, other business values. And we plot that against your needs, your wants, and your wishes. And when that extends, this surplus bucket exists because your assets exceed your needs, wants, and wishes. That tells us that, yes, we can be risky. So if we're feeling concerned about risk and we know whether or not we can take that risk, it kind of tells us here, like, look, we know that we're okay in the future. In all likelihood, we're great there. But where do we want to take that risk? And knowing whether or not we can take that risk, we can extend here into kind of an asset allocation, okay? And what we look at here from moving from left to right is the expansion in business equity and income producing real estate. So if you want to take additional risk, and right now 80% of your net worth is in business, then actually that would be an advocate for, yes, you should have some additional stocks, all else being equal. Or another way to look at it is to say all types of assets are not the same within those buckets. So what we mean by that is the riskiness of an apartment building in downtown Nashville is not the same type of riskiness in building a spec home in Nashville as well. Those are two different types of risks. The spec home is much riskier because you're hoping someone will buy it from you, as opposed to a Nashville building, which is, let's say, 90% rented up and cash flowing. So what you may do is, with that surplus bucket, you actually take a little bit of additional risk in an area where you feel comfortable. And when you're doing that, what you're ultimately achieving is you're recognizing the fact that personal finance is more personal than it is finance.